The next part of the training series is how to determine prospects, how to separate the suspects out of the prospects. And what we're looking for from that is we want to get to the actual data. We want to make sure that the numbers we're looking for are the as-is current numbers, current financial statements, current profit and loss statements, operating expense, income expense statements that we get from the property. Yeah, it's great that the property could produce this when it grows up, when the problem is solved, but we want to know what it's doing right now. And a lot of times what you're going to get initially from the brokers, from the sellers, is pro forma information. The pro forma information is what the property could take a look at, or could be worth when it's stabilized, when it's running at optimal value. That's great information for us to have when it comes time for us to sell it, so that we'll know what we might be able to get out of it when we're selling it. But we're not going to buy the property based on what it could be and pay the price of what it could be when we're the one going to have to do the work to fix it up. So in essence, we're buying a problem. We're going to buy it at a strong discount because it is a problem property. We're going to use our experience and expertise and resources to solve the problem, get it stabilized, get it running at maximum efficiency, and then sell it at or close to full market value for a stable property. Now, one of the top things for you to take a look at is most important things is the net operating income. There's going to be a video that deals specifically how to calculate the NOI, the net operating income, in this training series. So we won't go into that, but let's assume that you've got the financial statements that show the net operating income. Here's where you plug it into your property analysis or property acquisition worksheet. And with each property, you really need to fill one of these out, become very comfortable with it, very familiar with it, so that you understand the numbers that we're working on, so that when you submit your deals, we'll know right off the bat that it's a good one, that you've thoroughly researched it, and that we can process it through much quicker. Let's take a look at a sample property from one of our investor partners. This is an apartment complex in Texas. It is 51 units, moderate income value. The purchase price that we're looking at is $650,000. We anticipate that we can buy this with seller financing. $65,000 down, an additional $32,500 worth of closing costs and other assorted fees. This is where your fee comes in. That's part of our acquisition cost, and we'll look at maybe $97,500 worth of cash that is going to have to come up with out of pocket. Seller has agreed to finance the rest of it for us. Now, if you take a look, you enter in the number of units over here, the number of units, type of unit, the number of units, the monthly rent from each type of unit, and that annualizes it, multiplies it by 12, and let's assume right off the bat that there's 100% occupancy. The fields that you fill in are going to be blue. The pink fields calculated for you, so it multiplies that out by 12. 100% occupancy initially, and that gives you the gross potential income. From that gross potential income, you want to factor in a vacancy rate, 10%, 20%, whatever the case may be. Then you plug in an expense category over here. Just for estimating purposes, we plug in on this one 50%. That's probably not a bad estimate, usually somewhere between 40 and 60% depending on the type of asset that it is. Plug in 50% over here, multiply the total income, gross potential income down here by 50%, gives you this number over there. So in essence, you're looking at taking the gross potential income, subtracting the operating expenses from that, and it gives you a net operating income of $159,000. You plug in the numbers in the blue, the calculations are done for you, gets you a net operating income of $159,000. the debt service, calculate what if we're putting 10% down, that leaves 90% loan. Factor in, say, a 10% rate. Just put a number in there that makes sense. 10% rate. If we're going to have to spend $150,000 to fix it up, that's where this capital expenditure comes in. That gives you cash flow before taxes calculated for you of $75,000 negative. We spent more money the first year than we've made. But that also gives you a capitalization rate before you calculate any of the debt service or anything like that. If we're spending $650,000 and we're making a $159,000 net operating income, that shows us a capitalization rate of 24.6%. That's incredible. That's excellent. So this is a deal that we would very much jump on very quickly. It shows that even though we have to spend some money to fix it up, once you come down here and determine in your market what the capitalization rate is for apartment complexes, plug the number in here as a cap rate, you'll see that our apartment complex we spent $650 on, another $150,000 to fix up, so we're into it for maybe $800,000, is worth $1.8 million once we do the work, once we get it filled up to 90% occupancy. So this is a property that we would certainly want to get under contract as quickly as we possibly could and have a real good opportunity on it. But each project that you turn in, we would very much appreciate that you do your own property acquisition worksheet. That's going to be available for you to download. Run the calculations based on the as is. Most of the time your cap rate is going to be very low, because most of the time your income over here is not going to reflect this. If you'll notice, we come in and we put the occupancy rate, or let's say we've got to put in a vacancy rate here of 60%. It's only 40% occupied. You'll notice that changes out the numbers dramatically. This is more of an as-is type scenario. This gives us a net operating income of a negative $39,000. That's okay. We understand that it's running at a 60% vacancy rate. We understand that we can come in and we can increase the vacancy rate with better management, typically with better management and things like that. So don't let the cap rate, don't let the net operating income throw you. If it's got a negative net operating income, that's usually good news for us. That means that something's broken that we can probably come in there and fix. But you want to create a property acquisition worksheet using the as is, where it stands today numbers. And then if you want to come in and do a comparison, come in and put in the pro forma numbers to find out what it could grow up to be, the $1.8 million, and find out what the differences are. That will give you a really good idea.